I'm Ron DeLegge with ETF Guide TV, and it's great to see you again. These are the dog days of summer, and I hope everybody's summer is going well so far. Let's get right to it. Let's start with our $500 giveaway winner. And this is something that we started a couple of weeks ago. We made it easy for you. We said you could win a $500 IRA deposit or Roth IRA deposit from ETF Guide. All you had to do was join our email list. Well, the contest is over and we have a winner, and it's Bailey from Virginia. So congratulations, Bailey. And she joined our email list. She hit the jackpot. And Bailey said to me in an email that she never wins anything. Well, guess what, Bailey? You just won $500 into your IRA or Roth IRA account. So congratulations. And we'll be doing more giveaways on ETF Guide TV. So if you missed it, well, you missed it. Next up, I want to take a look at the pulse of the stock market's mood. And this is something that I regularly give you updates on. We're still in extreme territory. We've been this way for quite some time, most of this year, in fact. And we are in extremely greedy territory. This is the CNN Fear and Greed Index. And actually, it's a composite of, I think, 7 different factors that make up this index. But again, this is just one element of measuring the market's mood. And as the great Gerald Loeb said, that the only thing that matters when it comes to stock prices is public psychology. So public psychology right now, if you look at stock prices, is pretty bullish, pretty happy, pretty calm, pretty extreme in terms of being bullish. In terms of S&P 500 industry sector performance, the leaders continue to lead, and they continue to add to their gains. We've got XLK, XLC, and XLY. Those are the ETF tickers tracking the top 3 S&P 500 industry sectors this year. They've got gains all the way from 33% to as high as just over 42%. And you can see there that these, I've mentioned it before, these 3 industry sectors represent around half combined, when you combine them together, around half of the overall equity exposure of the S&P 500. So they are having a heavy influence on the S&P's volatility as well as its performance. And in terms of overall S&P 500 industry groups, we've got 9 sectors in positive territory and 2 that are down. And you'll notice those 2 that are down very modestly. XLE, which tracks energy, that was a huge winner last year. And XLU down again modestly, with the losses not even greater than 2%. So the overall message, if we take a look at this from an industry sector performance angle, is very bullish. Now, what has happened, if we look at history, to the S&P 500, if it's done what it's done thus far in 2023, it's gone straight up for what? Several consecutive months. This is Ryan Detrick. He's a CMT. And on his Twitter handle, this is a chart that he pushed out, and he said, listen, the S&P 500 has historically gone up 26 out of 28 times for an average 12.5% gain when it's performed like it has up to this point. And so very interesting historical look at, of course, those of us that believe that history is a pack of lies told by a bunch of people who weren't there can completely ignore this chart. In terms of the big 3 stock market benchmarks, we've got the QQQ, which tracks the NASDAQ 100, SPY, which tracks the S&P 500, and DIA, which tracks the Dow Jones 30, also known as the Dow Industrials. You can see the triple Qs are the runaway winners. They have gained just over 41%, and no surprises there. As I indicated previously, it's the tech sector that's been the runaway winners. And what do you think the triple Qs are? Well, it's a tech-heavy sector. You got some of the largest tech companies in that particular ETF. And the triple Qs are also, if you have not gotten the memo, they took a trip to Beverly Hills. Yeah, Beverly Hills isn't just for shopping. It's also the go-to place for elective surgery, also known as plastic surgery by the less refined. Now, why do I say that? Well, the triple Qs are going through elective surgery. They had this thing called a special rebalancing which got triggered because of the fact that some of the holdings within the triple Qs began to dominate the overall index and the performance. And so they had to call for a special rebalance, or what they say in Beverly Hills, elective surgery. That takes in effect, it began a couple of weeks ago, but it takes effect on July 24th. And basically, they're going to own the same companies, but they're going to reduce some of the ownership exposure to some of those companies. So we will have a different looking QQQ. It'll have a facelift, but it'll still be the same beast as always. This is my weekly reminder that single stock ETFs are outperforming the single stocks that they're tracking. And I've tried to bring home this point over the past couple of weeks. And of course, single stock ETFs continue to be hated. And I guess, what does that say? When something's hated as much and detested as much as single stock ETFs, that to me means it's kind of interesting. I want to take a look at it. I want to understand it. Keep in mind that we're still in the infancy of this single stock ETF craze. Most of these ETFs have less than a year of performance history, or close to a year. And I took a look at the performance of these single stock ETFs, which add 1.5% daily leverage. I looked at that versus the individual stocks themselves. And as you can see, in these two cases, we've got Tesla in this chart versus TSLL, and then NVIDIA versus NVDL. And in both cases, the single stock ETF with the 1.5 daily leverage is outperforming the single stocks they're tracking. And that's really no surprise, right? Because this is what's going to happen when these stocks are in a bullish run, when they're running on the upside. You're going to see the leveraged bull ETFs do the same thing, except with a little bit more higher performance. And by the way, that's Ron's rule for leverage. If you're going to use it, you want to do it in a market that's sharply trending in the same exact direction that you're trading in. In this case, the direction is clearly bullish. By the way, this same thing applies to other stocks that have single stock ETFs connected to them. This applies to Coinbase. It also applies to Apple. And so FYI, this is a story and a trend that I'm going to continue to report on. And I think it's a very, very interesting trend. And by the way, those single stock ETFs in the framework of portfolio construction, the DeLegge framework is a three-part framework. You got the core portfolio, which is always broadly diversified in low-cost index funds. That's your core. Your non-core can invest in things like this. These single stock ETFs, it can invest in non-core asset classes like volatility, gold, cryptocurrencies. You can use leverage in your non-core portfolio. You can go short. You can go long. You can do whatever you want. It's a go-anywhere type of situation. You can trade actively. You can buy and hold. You can invest in thematic ETFs. There's a lot of things you can do in your non-core portfolio, but it is the dessert. It's not the main course. And it supplements or complements your core portfolio. And then the third element is the margin of safety, which I'll talk about toward the end of today's video. But margin of safety is the portion of your portfolio that is earmarked for three things: zero volatility, capital preservation, and protection of your capital and liquidity. So those things are all part of your margin of safety. Now let's take a look at the performance of some ETFs tracking what we call hard assets, also known as things like real estate and commodities. And this is a chart looking at SDCI, which is a broadly diversified commodity index ETF, one of the best out there. If you're looking for a core commodities index ETF, this is a good place to start, SDCI. But you take a look at some of the other hard assets, and don't send me any jokes related to hard assets, because I know, all of you crazy minds out there want to send me some jokes about hard assets. You've got, the sarcastic ones watching. But you can see here that the leading performers are lithium, LIT, which is ahead by just over 11%. And then you also have Copper's in there, not up as much, but these two particular assets are closely connected to the movement and shift towards EVs and electric vehicles and new modes of transportation not involving oil and gas. And then, of course, you got gold in there, and REIT, REET, tracks global real estate. So hard assets have modest gains this year. In terms of recessions, what are the odds that we'll get a recession in 2023? Well, here's a historical look, and pay no attention to what the bow tie wearing economists who smell like musty books are saying about the U.S. economy, because they haven't been very good at predicting what's really happened, have they? Right? I think it was who was it? Paul Samuelson, the great Nobel laureate, who once said that U.S. economists have accurately predicted 9 out of the past 5 recessions. So you do the math on that one. So if you look at history, there has not been, and this chart from, again, Ryan Detrick, is it Detrick or Dietrich? You say potato, I say potato. Linguists, weigh in. What is the correct pronunciation of his name? Is it Dietrich or Detrick? I don't know. I'm from Chicago. We don't pronounce anything correctly. Anyway, if you go back to taking a look at this, going all the way back to World War II, there has not been a U.S. recession in a U.S. pre-election year, and that's what 2023 is, going back to the World War II era. Wow. That's a pretty impressive stat. Then again, you could be of the George Santayana camp, who once quipped that history's a pack of lies told by a bunch of people who weren't there. Again, if that's you, ignore that chart. Companies from Charles Schwab to Tesla have been flocking to Texas. I guess the allure of no state income tax and 115-degree weathers, along with you've got some pretty good barbecue there. But anyway, it's just too much for some to resist. But this is what a CNBC ranking says, that Texas is dead last place in terms of living spots. So I guess if you're from Texas, I sympathize. And by the way, I hate surveys. And if you're not happy with this particular one, you can complain to CNBC. Finally, with heavy hearts, we announced the loss of a few legends. Tony Bennett passed away at age 96, one of the truly legendary voices of jazz and American song standards. So what's your favorite Tony Bennett song? Tell me in the comment section below. I want to hear from you. I really enjoyed his work with the Ralph Sharon Trio. They were such a tightly woven bunch. But, I also enjoyed his duets with Lady Gaga and Amy Winehouse. He did a lot of collaborations. Links are below to some of my favorite songs from Tony Bennett. But again, I'd love to hear from you. And then also Evelyn Boyd Granville passed away at the ripe age of 99. She was one of the first black women to ever earn a PhD in math. She was a smart cookie. She worked at NASA and seemingly on every major math project of the 20th century. So condolences to both families. They're gone, but they're not forgotten. So key takeaways. S&P 500 sectors continue to paint a very bullish picture. We've got the greed and fear index at extreme levels. Greedy, greedy, greedy. And be careful. Be careful, because when markets are greedy, that's when you should be fearful. So it's a good time to be defensive. I'm not saying sell everything, but having and investing with a margin of safety is crucial. It's crucial in any market, especially a market that continues to go higher and higher. And there's a lot of folks that are having FOMO, and they're over leveraging. And so you want to be doing the opposite of the crowd. Single stock ETFs continue to beat their tracking stocks. That's been the case in 2023, and that's what you're going to see in a rising market, a bull market like we have right now. These stocks, or single stock ETFs, by the way, the opposite is true. When these stocks start to go down and sink in value, you're going to see the single stock ETFs perform worse, and that's because they use leverage. So just, it's common sense. It doesn't really require any, smart, degrees or anything like that. Now, the other thing is keep shifting money into the tax-free zone to avert the imminent threat of skyrocketing U.S. taxes. I've talked about this many times on this channel. I will continue to proclaim that message. Shifting money into the Roth IRA world, that can be through Roth IRA conversions, Roth 401k, or Roth IRA contributions if you qualify. Remember, tax-free is always better than tax-deferred, and it's certainly better than taxable. Finally, a couple reminders. Be sure to join ETF Guide's free membership club. We've got a lot of benefits. And if you're not a member, you're not benefiting from some of these benefits. We've got online courses, so that is something that you can participate in. You can also get my weekly note, which is sent out once a week. And some of the things that I share with you on this episode are included in that weekly note. But there's other tidbits that I don't share just because I don't have hours and hours to talk with you. So you'll be able to read that in my weekly note once you become a ETF Guide member. And then also exclusive invitations to live events like our retirement series, workshops that we do, as well as discounts and special offers on products that ETF Guide is building. And that's what I'm doing at ETF Guide. I'm building financial tools that can help investors just like you make better and informed decisions to help you protect and grow your money. One of those products is called my Margin of Safety product. And this is a product that I want to encourage all of you to go to etfguide.com. I have the link below and enroll, and it will help you calculate how much of your overall portfolio should be earmarked for safety. And it will also take you through a video library. I've got 20 plus videos that explain what the margin of safety is, how to implement it, and then you also get a chance to book a one-on-one appointment with me where we can talk about deploying your margin of safety and what specific financial instruments you can use to do that meet the minimum standards of safety. So that does it for today's episode. And again, we appreciate you watching ETF Guide TV. I hope your summer's going well. And again, visit the description section below and hit the like button if you've been enjoying our content, and the subscribe button. And don't miss any of our original series programs like this one, along with ETF Battles and Portfolio Makeover. I'm Ron DeLegge. We'll see you next time.